Japanese candlesticks are the language of the market and the foundation of technical analysis. If you can read a Japanese candlestick chart, you can start trading the market. Therefore, we'll get you on a fast track trading the market and seeing profits. And we'll do this by explaining what is a Japanese candlestick, showing the difference between a decision candlestick and an indecision candlestick, and how combining a decision with an indecision candlestick can create candlestick formations, and how these formations create points of entry and exits for potential profits. I'm excited to teach you this important aspect of trading, so let's get started. I'm really excited to be discussing with you all about how to read a Japanese candlestick chart, how to literally read the actual Japanese candlestick, as well as the anatomy or formation of that Japanese candlestick, and how you start to take several candlesticks, put them together, and create a candlestick formation, which in the end becomes a buy and sell signal for the actual trader, which is very, very helpful. Now, what you're trying to do as a trader is learn what's called spatial intelligence. And we're going to take two approaches to this. We're going to literally zoom out and take the overview of how it looks, and then we're going to zoom in, and we're going to zoom in on one or two candlestick formations so that you can start to see. So we're going to be zooming out and zooming in, teaching you exactly how to read these Japanese candlesticks. Now, here's the anatomy of a Japanese candlestick. It really all begins with what are called bullish candlesticks, which are green, and if it's a bearish candle, it will be red. Now, the reason they are called Japanese candlesticks is because they literally look like a candle with actual wicks on the top and on the bottom. Envision this is just like a candlestick wick on the top, candlestick wick on the bottom. And so what happens is you have bullish candlesticks with wicks, and you have bearish candlesticks with wicks. Now, what makes one a bullish candle and what makes the other a bearish candle? Well, see, it all begins with where the opening is. Because if you look at this candle right here, prices opened right here. Perhaps bears took control and they took prices down. Now, when they took control and took prices down, this low from the opening to there was a bearish candlestick formation. But then the bulls jumped in and they started to buy more than the bears were selling, which created what's called a bullish candle. And as a matter of fact, they took prices all the way up to this high during the time period and then brought it back down. And then the market closed right there higher than it opened, which is called a bullish candlestick formation. Now, the opposite takes place in a bearish candlestick formation. Prices open up here. Perhaps bulls took prices up for a few moments. You might have had a bullish candle with a green body, but then the bears took control and started to sell more than the bulls were buying and took prices down, perhaps creating a low right here and then closing lower than it opened. And so what you have here is you have what's called full-bodied candles. Now, all these candlestick formations you'll be able to read on all time frames because they form on all time frames. Because what's really taking place is trading is all about price movement against time. And so these candlesticks may form on a 1-minute chart. They may form on a 5-minute chart. They may form on a 10-minute chart. They'll form on an hour chart, 2-hour chart, 10-hour chart, a daily chart, a weekly chart, a monthly chart. If this was a monthly chart, this literally would be the opening of the beginning of the month. And then during the whole month, prices fluctuated up and down, but bulls took control and closed higher than it opened. And so this whole month, prices went up. Because what's really taking place in any candlestick formation is we're monitoring open, high, low, and close. So when, once again, the close is higher than the open, it's a bullish candle, and it's green. And when the close is lower than the opening, it's a bearish candle and red. But like I said, it's all monitoring the open, the high, the low, which are the wicks. The highs are the wicks here, and the close. Okay? So this is the anatomy of a candle. Now, what I want to discuss now is I'm going to be going into what are called the decision candles, and we're going to go into what's called indecision candles, as well as indecision candles that are really buy and sell signals. But if you take a good look at this chart, these are your decision candles. You have a bearish decision candle here. You have a bullish decision candle here. This is a bearish decision candle. This is a bullish decision candle. So let's discuss decision and indecision candles. We've discussed already the bullish and bearish decision candles with highs and lows, which are the wicks. So let's discuss what is an indecision candle. This is called a spinning top, and this is called a doji star. Now, what is taking place with a spinning top is this body can be bullish or bearish. It can be bullish or bearish. And so if it is bullish, as it is here, prices opened up here. Perhaps bears took prices down, created a low. When bulls jumped in and took prices up, it left the wick behind. And then as soon as prices went beyond the opening right here and started to rally, the actual candle was bullish, creating a high, and then bears brought it down, and they closed near the opening, which is called an indecision candle. Very different. You can see the bodies of indecision candles are very small compared to the bodies of decision candles. This is called a doji star. Now, many times these doji stars open and close at the same price. But sometimes you'll have a small bearish body, and sometimes you'll have a small bullish body. This can be bullish or bearish. But see, prices open up very close to where they close, and at one time the bears had control, and this was a full-bodied bearish candle at one time. But when bulls stepped in and brought prices back up, it literally became a bullish candle with a long wick to the south, and then the bears came in, brought prices back down, and closed near or at the same price that it opened. Once again, these are called indecision candles. See, the bulls don't know whether they're going to maintain control. The bears don't know whether they're going to maintain control. And literally, this is called the war zone. It's where the bulls and the bears are really fighting for control, because trading is all about taking control. Bulls want the prices to go up. They want to maintain prices going up, making higher highs and higher lows, which is called an uptrend. And bears want to maintain control by making lower lows and lower highs, which is called a downtrend. But see, they're constantly fighting over price. Now, this is what's called a indecision candle. Now, if you really look at this, this is called a hammer. If you envision grabbing the bottom of this, and this is the head of the hammer, see, that's how I remember it anyway. But if you look at this, prices opened up here. And then at one time, this was a full-bodied bearish candle. And so then when it was a full-bodied bearish candle, bulls jumped in, took prices up, see? When it was a full-bodied bearish candle, there were more sellers than buyers, more sellers than buyers, more sellers than buyers, more sellers than buyers. And then all of a sudden there became more buyers and sellers, more buyers and sellers, more buyers and sellers taking prices up. And then it closed near the opening, creating what's called a hammerhead. See, so this is what's called a hammer. Now, if you really think about what's taking place, is see, bears tried to bring prices right down and take control. But bulls took control and brought prices back up. This is an indecision candle that really is a decision candle, because it's communicating to the trader that prices are getting ready to shoot up. That's what the long wick means at the bottom. Now, if you look at this dragonfly doji here, this opened up here. Bears took control a little bit, took prices down, and then bulls took prices all the way up, created this high. At one time, this was a full-bodied bullish candle, But during the time period, the bears brought prices back down, and this is a bearish signal. See, when you have long wicks on the north side of a small-bodied candle, that's a bearish signal. And when you have long wicks on the south side of a small-bodied bullish, that's a bullish signal, meaning prices will usually go up after that, just like prices will usually go down after this one forms. Now, if you take a good look here, what you see here is you see your full-bodied bullish candles that we discussed. And then you start to see what are called your indecision candles right here, indecision, spinning tops. These are bearish spinning tops. And then you see a bullish hammer that forms. Now, once again, to become a good trader, you have to develop your spatial intelligence, and that's what this lesson is all about, developing your spatial intelligence, being able to read these charts, being able to read these candles. Now, once again, you see a chart with many types of candlestick formations, and now we're going to be talking about the doji star. So this is the these are called spinning tops, doji stars. And you know, I call them spinning top doji stars because they have a little body. But truly, if it was just a flat line here or a flat line there, it really would be called a doji star. But because the body is so small, I don't want you to confuse these with a true spinning top. A true spinning top is going to have a body like that. These are very small bodies, which are your doji stars. They're called doji stars. So take a look. Once again, we're zooming out so that you can kind of see the different candlestick formations. I want your eyes to kind of scan over these charts and over these candlesticks to see if you can spot full-bodied candlesticks, if you can start to spot indecision candlesticks, if you can start to spot decision candlesticks, and if you can start to spot the doji stars that we talked about. Now, what I want to talk about next is what are called dragonfly dojis. This is a bullish dragonfly doji. We talked about long wicks on the body create a bullish movement right after. You can see the bears were in control, indecision came in, but communicated to the trader, hey, because of this dragonfly doji here, this was going to take off. And so here it took off to the north, and then we have communicated to us a long wick to the north, which is a bearish signal. Once again, these can be bullish or bearish. I'm going to zoom out again so you can literally see the candles again. Okay? So what we're going to talk about next are what are called gravestone dojis. Now, this is a dragonfly doji. This is a gravestone doji. What really is the difference here? If you take a look here, this one does not have a wick on the bottom where this one has a wick on the top. So stay focused on this. Either way, this is a bearish signal. Now, here is your bullish dragonfly doji. This is a bullish. See, bears were in control. Think of it. At one time, this candle looked like this. But then bulls brought the prices back up. They intervened, and there was more buyers and sellers, and closed higher than it opened. Small body once again, large wick on the south. Take a look once again and see if you can see full-bodied with indecision candles, what you've learned so far. Indecision candles. Let's talk about spinning tops. Now what we have here is we have a spinning top, which is an indecision candle with a bearish body, and then we have a spinning top with a bullish body. Either way, this is the war zone that I talked about. A lot of indecision going back and forth. And I'm going to zoom out again, see if you can find those spinning tops. See, here's a spinning top right here. Here's somewhat of a spinning top, a little larger body. Here's another spinning top right there. Can you see it? Okay, now let's take a look here, because what we want to talk about is we want to talk about what's called a hanging man. This is a hanging man right here. I want you to envision this being a rope, and I want you to envision this being the head of a hanging man. This is a bearish signal. Prices were going up. And then all of a sudden you have this huge wick on the north side of a very small body, a hanging man. To where this is the opposite, which is that hammer we talked about. Usually prices will go up because you have the long wick on the south side, you have the long wick on the north side, prices will go down, prices will go up. And so, once again, I want to zoom out and help you understand that you are looking at what's called a Japanese candlestick chart. And Japanese candlestick charts are monitoring price movement, which is right here, price movement against time. This is time. And once again, these candlestick formations form on all time frames. And so we're getting ready to talk about when you start to mix two candlestick formations together, or perhaps three or four, you start to get buy and sell signals or bullish and bearish candlestick formations. And what I'm going to be talking about next are the actual formations and how they really help the trader find trades to become successful. Now we're getting ready to discuss the 5 most important bullish candlestick formations or signals that a trader must learn in order to really participate in helping him become successful at trading in the market. I need to tell you, in my 30 years of trading, learning Japanese candlesticks and the 5 most important bullish as well as the 5 most important bearish literally changed my trading completely. Now, there are 7 technicals that I've come to realize that play a big part in helping a trader learn how to become a consistent, profitable trader. And Japanese candlesticks and learning the bullish and bearish formations play a huge part in helping a trader become consistently profitable. So let's get started. What you see here is a bullish shooting star. Now, a bullish shooting star, as it forms with a bearish full-bodied candle followed by a somewhat indecision candle. That's really a decision candle. We discussed this earlier. Now what you see here is the bears were in control, and then all of a sudden the war broke out between the bulls and the bears. And then you see that as this war broke out, the market opened up here with this candle. Bears brought it down, leading the trader to believe that this market was going to continue to fall. But then the bulls pushed it back up, leaving a long wick on the south side of the closed body, small body of the next candle. This is called a bullish shooting star. And one of the things I need you to realize is that the 5 bullish candlestick formations are literally telling the trader the market is about to U-turn. See, it's about to U-turn and it's about to rally next. And so how do you trade this when you see it? You literally place a trade at the opening of the next candle with a protective stop at the low. Now, what's the trader expecting to happen next? They're expecting the market to break out to the north and provide them with a nice profit. Let's look at what it looks like in an actual chart. Here you are sitting watching the charts, the market's fluctuating, and you're looking for a bullish trading opportunity. And all of a sudden, the market creates what's called a bullish shooting star. This is what it looks like. It's these 2 formations. Literally, this is what's called a double bottom with you having these 3 lows. This is somewhat of a triple bottom. But with this bullish shooting star, it is really telling the trader this market's getting ready to explode to the north. And so you would literally enter the market at the opening of the next candle. You have to wait till these candlestick formations close in order to get the actual formation. But when they close and you see the actual formation, then you would buy at the opening of the next candle, placing a protective stop below. That would be your risk, see, small risk, and we're anticipating a big profit. See, if this was your risk and all this was profit, wouldn't you be somewhat of a very happy trader, thinking, wow, I made the right decision, and here you go. All of a sudden, the market goes to the north. Let's discuss what's called a bullish morning star. Now, a bullish morning star is somewhat like a bullish shooting star, but instead of 2 candles, it has 3 candles. And instead of it having perhaps a hammer in the center, or even a dragonfly doji, a bullish dragonfly doji, it has what's called a spinning top. Now, most morning stars do have a spinning top in the middle. You had bears in control, followed by the bulls and the bears fighting it out, followed by the bulls taking clear control. This formation is called a bullish morning star, and it is a U-turn. How do you trade it? You trade it at the opening of the next candle, after the candle closes, and after the formation appears with a protective stop-loss order at the bottom. This is what it looks like in the market. All of a sudden, you're sitting there anticipating the market to provide you with a bullish signal because you're expecting the market to go up, and the market provides a bearish candle, followed by an indecision spinning top, followed by another indecision spinning top. See, the actual formation we showed you before is called an ideal morning star. But many times, this is more the realistic morning star that appears. Many times you'll see even 6 indecision candles in between, because you had the bears in control, then you had the war breakout. Bulls and bears fighting it out. Indecision, followed by another indecision. If we were watching an hourly chart, this would be an hour bearish, followed by an hour of indecision, followed by another hour. Let's just say there were 6 candles in between, followed by 6 more hours of indecision. But when a bullish candle appears, the market is U-turning. You can see it's waving like this. And so there's your morning star, and this is what happens after the morning star appears. The trader is anticipating a bullish move. Next, we have what's called a bullish piercing line. Now, a bullish piercing line is when you have the bears in control, and then all of a sudden, bulls take control, and they bring the actual market back more than 50%. Actually, in order for a piercing line to be an actual piercing line, the close of the candle has to be beyond 60% of the body of the previous candle. And so this, once again, is a U-turn. How do you trade it? You enter at the opening of the next candle, protective stop at the bottom. This is what it looks like in the market. You've been watching the market. You've been anticipating this market to break out to the north. Market breaks a downtrend line. All of a sudden, in the first little wave, it creates a piercing line, which is a signal this market is going to break out to the north. It came back more than 60%. And what took place after that? When the piercing line appeared, the market broke out to the north. See, these candlestick formations make traders very, very happy when they see them, because a large majority of the time, perhaps 80% of the time, these candlestick formations are true to their formation, and that's where the actual U-turn takes place. Now, this is the most popular bullish candlestick formation. It is called a engulfing bullish candle. It's where the market was bearish, and then all of a sudden you had the bulls take control, and this bullish full-bodied candle engulfed the previous 3 candles. Once again, it is a U-turn. How do you trade it? You enter at the opening of the next candle with a protective stop loss at the bottom. This is what it looks like in the chart. The market is starting to move, and then boom, there's your engulfing bullish candle. That's the actual formation. And then you have the market explode to the north, which is what candlestick formations are communicating to the trader, what the market's about ready to do. Now, the last of the 5 is called a tweezer bottom. Believe it or not, tweezer bottoms don't appear that often, but when they appear, they are very solid candlestick formations. What you see here is you see 2 indecision candles followed by the market exploding to the north. This is a U-turn. This is where the wicks on the bottom need to be more than 60% of the whole entire candle. Usually you have very small bodies of the candle. Those bodies of the candle can either be bullish or bearish. They can both be bearish, they can both be bullish. It doesn't matter. Now, this is what's called an ideal candlestick formation for a tweezer bottom. It is once again a U-turn. How do you trade it? You enter at the opening of the next candle, place a protective stop loss order there. But I want to share with you something. Let's just say this first candle appeared, and then you got a bunch of indecision candles in between. Let's just say you're watching a daily chart, and you had one day where this candle appeared, and then you had followed by 10 days of indecision, a whole bunch of spinning tops, because a chart is a chart is a chart, and all these candlestick formations are going to appear on all time frames. I don't care if you're looking at a minute chart or a 4-hour chart or a daily chart, a yearly chart. These candlestick formations appear on all charts. Now, this is what it looks like in the market. You've been waiting for the market to go up. Why? The market has started to make higher highs and higher lows, and then all of a sudden the market comes down, forms tweezer bottoms. Now, based on what I've taught you so far, how would you trade this? Wouldn't you want to buy this right here, placing a small protective loss stop order and try to capture a whole bunch of profit? See, this is your tweezer bottom formation, and after entering the market, you would be risking very little to capture a lot. Now, if you really think about it, this is what trading is all about. It's learning where to get in and why, learning where to place a protective stop loss order that lands within equity management, meaning we're going to risk very little to capture a whole lot. And this also participates in helping the trader find comfort in the number that it's trading, because after all, trading can be very fearful. It can take a trader and make him very anxious. But when you start to see candlestick formations that start to appear in the direction you want to be trading, you've now taken your trade from a 50-50 to perhaps an 80 to 90% trade in your direction. And that's what we all want in the end, is to find that comfort in the numbers that we're trading, feel good about our trades, get in that trade with equity management, and just let the market do what it's going to do. Now let's discuss the 5 bearish candlestick formations. I want you to envision yourself looking at the charts. You're starting to watch the market trend down. The market's making lower lows and lower highs. And so as the market makes lower lows and lower highs, it waves. And so every time it starts to wave and pull back up, we're going to be looking for a bearish candlestick formation after the retracement of a nice down move. And so with that bearish candlestick formation, that will be a signal that the market is getting ready to now make a new lower low and a lower high. And so let's start off with the bearish shooting star. Now, the bearish shooting star is the exact opposite of a bullish shooting star. It's just that instead of the market going bullish, this is going to go bearish. You have a full-bodied bullish candle followed by a indecision decision candle. This is somewhat of a hanging man or a dragonfly doji, if you will. This, once again, is a U-turn. It's communicated to the trader. The markets may have been rallying and now is getting ready to U-turn and make a lower low and start to break out toward the south. When you see this candlestick formation, how do you trade it? In the exact opposite way that you would a bullish candle. You would enter the market at the opening of the next candle, place a protective stop loss above the high with an anticipation of the market continuing to fall. This is what it looks like actually in the actual market. Now here you are sitting in front of your computer. You're watching these candlesticks form. You could be watching a 5-minute chart, 10-minute chart, 20-minute chart. You could be watching a half-hour chart, hourly chart. But all of a sudden you see the market is waving down and now has retraced back up. And after the retracement of this down move, all of a sudden you see a bearish shooting star. Now this bearish shooting star is literally communicating to the trader, we're about to incur a U-turn. This is what it looks like. It's those two candles together. And so how would you trade it? You would enter the market here, placing a protective stop above there, and this becomes all your profit. This is what happens. See, we'd be anticipating the market to be coming down, because trading is all about buying low and selling high, and shorting the market is just doing the opposite. You enter the market selling first and buying second, but you need to buy low and sell high in order to make a profit. Here we have what's called the bearish evening star. Now remember, we had the bullish morning star. This is a bearish evening star. This is once again, a U-turn that is communicated to the trader. What you have is you have that bullish candlestick formation, followed by indecision, followed by decision. Complete U-turn. It's telling the trader market's getting ready to blow south. And how do you trade it? You enter at the opening of the next candle, placing a protective stop loss order at the top. This is what it looks like in the chart. The market's been moving down. All of a sudden, the market moves up, and you have a bearish evening star, the opposite of a morning star. This is what it looks like. How do you trade it? You enter at the opening of the next candle, and once again, you have to wait till these candlestick formations close. Once they close, you'll enter at the opening of the next candle, placing a protective stop loss order up at the top, and anticipation of the market going down. That will be all your profit. See, risk right here versus huge reward. That is what trading is all about. And so this is what's called a dark cloud cover. Now, a dark cloud cover is the opposite of a piercing line. See that bullish piercing line? It's really the same formation, but in the opposite direction, and called a different name. Instead of it saying bullish piercing line, bearish piercing line, you have a bullish piercing line and you have a bearish dark cloud cover. Now, this is where you have a bullish candle. You have the bears come in, take control. They take the candle lower than 50% of the previous candle. As a matter of fact, to have this be a valid dark cloud cover, the market needs to come more than 60% and close. This is a signal to the trader the market's getting ready to go bearish. It is a U-turn. How do you trade it? Just like you do all the other ones. You enter the market of the next candle, place your protective stop loss order above the high with anticipation of the market going south. This is what it looks like in the market. You're sitting in front of your computer. You're looking for a bearish candlestick formation. As you're sitting there, this appears. This is your dark cloud cover. Market came back more than 60%. This is what it looks like, the two candles. The dark cloud cover is not 5 candles. It has to only be 2 candles. And what do? You enter the market at the next candle, place your protective stop with anticipation of all this being your profit. This is what makes a trader very, very happy and very excited to be trading. See, this knowledge makes a huge difference in a trader's journey, because once you learn these candlestick formations, it opens all kinds of doors of profitability for the trader. This, once again, is the most popular candlestick formation. This is the bearish engulfing candle. This will appear more than all of the other 4 combined. When this appears, it really is bulls were in control, followed by a bearish candle that engulfs the previous 3 candles. It can engulf the previous 1 or 2 or 3 or 4 candles for that matter. It, once again, is telling the trader, hey, look, this market is getting ready to U-turn and go back down. And so if you want to make a profit, you better get in right here, place your protective stop loss above the market, because just in case this starts to rally and we're wrong, you've got to remember the market is always right. That's why you always have a protective stop loss order, to make sure that if you are wrong, you incur a small loss in comparison to a large profit that you're going after. This is what it looks like in the market. Market was waving down, started to retrace, created a nice engulfing bearish candle. You enter the market right here. The previous 4 candles created your engulfing bearish candle, and you place your protective stop loss order above the high with anticipation of the market going down. And this is what it looks like. Market goes down in your way. As it starts to go down, it waves, because that's one thing the market does. Now, of the 5 bearish candlestick formations, once again, the tweezer top formation, which is the opposite of a tweezer bottom, appears the least, but is a very powerful candlestick formation for a trader. Even though it may be a powerful candlestick formation for a trader, you will never bet the farm on it, okay? That's not what trading is all about. But it is telling the trader, because of these indecision candles, these are basically somewhat of hanging men. They're called hanging men. This would be the rope. This would be the head, if you will. These are also considered bearish dragonfly dojis. These bodies of the candle could be bullish together. They could be bearish together. They could be bullish and bearish like they are. But what you need is 60%, at least 60% of the wick to be on the north side. Now, what this is communicating to the trader is that this market is really getting ready to take off in a bearish manner. It is a U-turn signal once again. How do you trade it? You enter at the opening of the next candle, placing a protective stop loss order above the high. This is what it looks like in the market. See, here we are. Look at how clear and distinct these are. These two tweezer tops are very different than all the other candles. And it's after a wave or a pullback. See, it's going to create a lower high, which is lower than the previous high. How do you trade this? See, this tweezer top, you trade it by entering at the opening of the next candle, placing a protective stop loss order, risk versus reward. That's what trading is all about. And then here we have the market taking off in our direction. One of the things you need to realize as a trader is there are no absolutes. You can't ever say the market always does this or the market never does this. You can't say that. What you have to say is when these type candlestick formations appear, they land in perhaps a 70, 80 percentile of market movement or U-turn. And it is a high percentage profitable trade. That literally is a signal. See, the 5 bullish candlestick formations are bullish signals for a trader. The 5 bearish are bearish signals for the trader. And so learning spatial intelligence and understanding how these candlesticks formations form really participate in helping a trader become that consistent, profitable trader, which is what they want to do in the end. Now we're going to go into the charts, and we're going to start looking for bullish and bearish candlestick formations, and then show you firsthand how they're traded, to include an entry, protective stop loss order, and the limit for profit. All right, what you're looking at is the British pound traded against the New Zealand dollar, and we're looking at a 1-hour chart, which means every single one of these candlesticks represent 1 hour of time. We've gone over all the different candlestick formations. As you look at this, you can kind of see many of the different candlestick formations, but what we've really seen is that this market is literally U-turning. See, one of the most important things that a trader can do is literally find trend direction. You have to find trend direction, because if you don't find trend direction, you literally don't know whether you should be trading a bullish candlestick formation or a bearish candlestick formation. There's a saying that goes like this: the trend is your friend until it bends. And so what was happening here is the market was literally in a downtrend, waving down. And as long as the market is below a trend line, it is literally 80% bearish. But once it moves and breaks the trend line, then it is 80% bullish. Now here we're north of this trend line, and the market appears to start to be making higher highs and some higher lows. And therefore, with knowing that the market is starting to rally, we need to be looking for one of the 5 bullish candlestick formations. And one of those 5 bullish candlestick formations are bullish shooting stars, morning stars, a bullish piercing line, a bullish engulfing candle, or a tweezer bottom. And so if you were sitting in front of your charts and you saw that the trend line has been broken, you literally would be looking for one of those bullish candlestick formations to enter the market. Here we can see the market's starting to retrace, and so we'd be looking for some sort of bullish engulfing candle that would tell us that this market is getting ready to rally. Now, here we have a bullish engulfing candle. Now, the example that I showed you, which was an ideal example, was that the bullish engulfing candle engulfed 3 bearish candles. In this one, it's only engulfing like 1 1/4 of the previous candles, which is still an engulfing bullish candle. Now, I want you to look over here, because trading is all about risk versus reward. And whether we are buying or selling, we've got to make sure that if we were going to risk $1, we'd want to try to capture at least $3. And so here, if this was our risk, this would be $1 in profit. This would be $2 in profit. And of course, that would be $3 in profit. That's literally a little more than 3 to 1. That's about 3 to 1. And so what we would do here is, now that we see this engulfing bullish candle, we're going to come in here and we are going to wait till the candlestick closes. In this case, the candle is closed. We are going to buy the market right here. Right there, we're going to buy the market. You're going to place an order to enter the market. You're going to place your protective stop loss order a little below the low. This is your risk. If this market turns around and comes back out, you will take a small loss. And then we're going to take a 3 to 1 risk-reward ratio, and this is going to be our profit, and we're going to get out right there. Now, the neat part about a trade like this is, here's your risk, here's your reward, 3 to 1. Great part about a 3 to 1 risk-reward ratio is that you can be wrong 70% of the time on a 3 to 1 risk-reward ratio. As long as you stay true to your 3 to 1 risk-reward ratio and only look for trades that are 3 to 1 risk-reward ratio trades, you can be wrong 7 times out of 10 and still deposit money in the bank. Now, in this case, here's a bullish engulfing candle. I want you to know that most bullish candlestick formations start to offer that 3 to 1 risk-reward ratio. But even if you started to do 1 for 1, you need to understand that 70 to 80% of the time, candlestick formations that are traded in the direction of a trend will pay off 70 to 80% of the time. So even if you go 1 for 1, you still will be able to deposit money in the bank. In an uptrend, you'd be looking to buy the 5 bullish candlestick formations. In a downtrend, you'd be looking to sell the 5 bearish candlestick formations. But now we found a trade. We put our buy here, our stop loss here, and our profit there. There is absolutely no need at this point to sit in front of this computer and watch this play out. This market is going to move on its time frame, not your time frame. If you only have 4 hours to trade, what's going to happen is you're going to start to sit there in the hopes that this market is going to pay you in 4 hours. It may pay you in 4 hours. It may not pay you in 4 hours. But the fact that you're able to set it and forget it is huge, because now that you found this trade, you literally can walk away, come back 8 hours later, come back 12 hours later, come back the next day to see how your trade's doing. Because literally, when you come back, one of 3 things will take place. The market fell, stopped you out for a small loss. The market started to rally and is still in the profit zone and hasn't hit your profit limit yet, or it's rallied to the point to where it limited you out. So let's watch what takes place here. Here we found the engulfing bullish candle, and then the market starts to move. Like I said, no need for you to sit here. It's going to move on its time frame. And so here the market starts to go sideways, and then boom, it takes off in the direction of the actual engulfing bullish candle. There's one really neat thing about candlestick formations is When a bearish candlestick formation appears, just like you see here, we have an evening star right over here. For some reason, there seems to be a push in that direction, almost the same distance as the actual candlestick formation. Here's a morning star right here. You see, if we bought this, if you take the distance between this low and the close of that candle, you can see it pushed in that direction. Because what's taking place is when the bulls create a bullish candlestick formation, they're literally saying to the bears, in your face, we're taking control of this market. And that's the neat part about candlestick formations. Now, this is what took place in a bullish candlestick formation that appeared. Now, as the saying goes, what goes up must come down. And so what we're going to do is we're going to go through this, and we're going to go and find us a bearish candlestick formation that you can see to take advantage of this market. Let me find my little cell here and come over here. And then all of a sudden we see right here, and I want to move this to the side, this market has been making higher highs and higher lows. This is where we bought. It's been making higher highs and higher lows. And then all of a sudden, you know, once again, our responsibility is find trend direction. The trend is your friend until it bends, and you can see here the market has bent. The market has penetrated the uptrend line. It is no longer making higher highs and higher lows. It's starting to make lower lows and lower highs. And so what we're doing is we're waiting, in this case, for a bearish candlestick formation to appear. So here we're sitting. Now that the market is going bearish, we're waiting for one of the 5 bearish candlestick formations to appear. What are they? They're a bearish shooting star. They're an evening star. They're a dark cloud cover. They're an engulfing bearish candle, or even a tweezer top. Those are the 5. And so here we are sitting, waiting for a bearish engulfing candle to appear, and then all of a sudden, boom, here you have a bearish engulfing candle to appear. Now, you don't know whether it's going to be an engulfing bearish. I just know that the engulfing bullish and engulfing bearish appear more than any other candlestick formation. But here we have a bearish candlestick formation. And so we go ahead and we literally short the market right here. This is the candlestick formation. We put our stop a little above the high. There's the actual formation. You can see it. And then we want to come in with reward, about a 3-to-1 risk-reward ratio. Here we sit with a 3-to-1 roughly risk-reward ratio. And we'll go, here's 1, here's 2, and here's 3. We just got to make this a little bit larger here, just right here. And so this becomes our sell now. Now, the neat part about this is we enter the market selling, okay? We quantify our risk and put our stop loss order above the high, and then we put our limit order for profit right here at the bottom. Once again, you can set it and forget it. There's no need for you to be sitting in front of this computer. The engulfing bearish candle has appeared, and so you just can walk away because the market's going to start to wave. And as it starts to wave and come down, this market is moving in our direction. And so here we are with this market moving in our direction. Now let's go look for a bearish candlestick formation and how you would actually trade a bearish candlestick formation. Once again, the number one responsibility of a trader is to find trend direction. You find that by drawing your trend lines. See, the trend is your friend until it bends. In this case, the market was making higher highs and higher lows until it literally broke the trend line. And now we are looking for bearish candlestick formations. So the market, you can see, is starting to retrace. Now, once again, we're looking for risk-reward opportunities of a 3-to-1 risk-reward ratio. There are several candlestick formation strategies that you'll be learning. But in this case, let's stay focused on our 3-to-1 risk-reward ratio. Because the market's moving down, we're looking to short the market and trying to find one of the bearish candlestick formations. And all of a sudden, an evening star appears. See, we have a bullish candle followed by that spinning top indecision or dragonfly doji. I'll bring it up so you can really see this, followed by a decision bearish candle. Now, trading once again is all about risk reward. We bought the other one with a stop loss order below our entry and a limit for profit above our entry. In this case, we are going to now be selling the market right here. We're going to be selling the market right there. We are going to now place our stop literally above the market. There's our stop. There's our sell entry. There's the evening star. And then we're going to go with a 3-to-1 risk-reward ratio. 3-to-1. This is 1. This is 2. So we literally need to come up with 3. That would be 3 times risk-reward ratio. And so we'll bring this down to about right there. There's your 3-to-1 risk-reward ratio. There's our entry right at the close of that candle. There's our risk. We now can set it and forget it because we have our sell right here, and there's our stop loss order above the high with our limit for profit right there. 3-to-1 risk reward ratio. And so no need for you to be sitting in front of this computer. And here we are, because the market is making lower lows and lower highs, we're looking for one of the 5 bearish candlestick formations. A nice evening star appeared. And so there we set it and we forget it. We can come back perhaps 8 hours later. We can come back 24 hours later. As I said, one of 3 things will take place when we come back. We will either A, be stopped out because the market rallied, B, still be in the market, or C, the market has now fallen to the point to where it took us out, limited us for a profit. And this is what literally successful trading is all about, in using one of the really important technicals, which is recognizing your bullish and bearish candlestick formations and then trading those candlestick formations in the direction of the trend. Learning all about Japanese candlesticks as a trader literally changed my life. I can't tell you how excited I was to learn about what Japanese candlesticks communicate to the trader, because a Japanese candlestick is communicating to the trader what it's about to do or may potentially do, or what it may continue to currently do. And as we showed you, as candlestick formations form, they create indecision formations, which means the market may continue to consolidate, or they create a signal, which means it may break out in a direction which could create huge profits for the trader. You see, candlestick formations literally are telling the trader where the market is about to U-turn and take off in a direction. That's the value to the trader about these Japanese candlesticks. And see, the reason we taught you these Japanese candlestick formations is so that you can take these formations and create a trading strategy from those formations in order to make the consistent, profitable trades that you always wanted to make as a trader, and so that you could participate in learning along the way how to become that master trader instead of that disaster trader, and help you achieve your dream of becoming that trader that you started off to be.